The reason why the challenges that we're facing are so unique right now is because most of us, myself included, have never lived through a time of true quantitative tightening. The last time we've seen true quantitative tightening was after the inflation that we saw in the 1970s and early 1980s. After that, we've been in an era of quantitative easing, and what that means is we've been in an era since the 1980s of loose money, low interest rates, and easy access to capital, meaning money entering our economic system. And that makes for an economic growth period because when you have more money entering the economic system, well, there's more money for people to buy things. Think of it like stimulus checks. If stimulus checks are going to people, people have more money to spend. Now, this quantitative easing isn't just in the form of stimulus checks, but it's in the form of spending. When the government spends more money, they can create more jobs. They can hire more contractors. They can pay more things because they can pay for more services. That's quantitative easing because it's creating more money that's entering our economic system. And right now, because of all the high inflation that we're facing, we are seeing the opposite happen. We are seeing quantitative tightening. Now, quantitative tightening is a couple things happening. Right now, what we're facing is the higher interest rates. The higher interest rates are there to reduce demand for products. The reason why we're facing high inflation is, one, because the government printed all this money with the help of the Federal Reserve Bank. So this created a lot of demand for things. A lot of money was printed and created, trillions and trillions of dollars. Some of this money was given to people. Some of this money was given to corporations. Some of this money was given to banks and institutions. Some of this money was given to the government. But a lot of institutions, people, and entities had money. Now, when you have money, what do? Well, you spend it. People took this money and they started shopping at Amazon, Lululemon, wherever. Businesses took this money and they started buying more factories, opening more places, starting new divisions. And we saw institutions take this money, banks and institutions take this money and start investing into real estate. They started investing into startups. And so we saw a lot of money flow into our economic system, which contributed to the economic boom that we saw in 2020, 2021, and even into 2022. Then in 2022, things changed when the Federal Reserve Bank started the shift. They started shifting from quantitative easing to quantitative tightening because in quantitative easing, it was cheap interest rates and a lot of access to easy money. Well, when the Federal Reserve Bank started raising interest rates, they said that they're now going to shift from this quantitative easing to quantitative tightening, which means higher interest rates and less free money out there. So now when you're a business that's been relying on super cheap debt, or when you're an institution that's been getting money very easily, that way you can invest into other startups, you didn't really need a very big return to justify the spending that you were doing. Today, with interest rates significantly higher than where they were 12 months ago or 16 months ago, it's a completely different decision. Businesses are cutting back on spending. Banks and institutions are cutting back on lending. We're seeing people cutting back on spending. It's completely changing the dynamic of our economy, and our economy runs on, spending. When people have more money, they can spend more, which allows the economy to grow faster, right? When you go and you spend more money at Sweetgreen makes more money. They can open more stores and hire more employees. If you don't have the money to go out and buy a salad at Sweetgreen, they're not going to be able to afford more employees or open more stores. And so when you have an economy that runs on spending, when you have more money in the economic system, people have the ability to spend more. But when you're seeing the tightening, like we're seeing happen now, people's ability to spend reduces, businesses' ability to spend cuts down, and institutions' ability to invest also shrinks. This is where now we're starting to see a lot of different opinions about what might be coming next, because we have some people saying that interest rates are going to go down. The Fed has to start cutting interest rates. Why? Because, we haven't seen interest rates this high for a long time, and it's hard to sustain interest rates this high. Although historically, the interest rates that we're seeing right now are still not historically high. On the other end, we have people saying the Fed is going to have to raise interest rates even more because in order to bring inflation down, the Fed has to be more aggressive with the higher interest rates. However, the higher interest rates have a cost, and that cost is a slowdown in the economy because higher interest rates make borrowing money much more expensive and it reduces spending. When you reduce spending, that slows down the economy, and we're already seeing an economic slowdown. So the question is, how much pain is the Federal Reserve Bank willing to endure? And this is where now you have entities like JP Morgan Chase Bank talking about how you better be prepared for even higher interest rates. Now, we've been covering all of this in market briefs. Market Briefs is my free financial newsletter, and this is why if you haven't joined yet, I highly recommend you do so because you don't want to be blindsided by what's happening in the economy. We're working to keep you up to date with unbiased news daily. It's a free newsletter that you get 6 times a week. So if you haven't joined Market Briefs yet, it's a super fun read. It's easy to read and it's completely free. And I got the link to how you can join down in the description below. The issue is, while inflation has come down off of its highs, it's still extremely high. Remember, the Federal Reserve Bank wants to see inflation come down to 2%. We're still significantly higher than that. And this is where the Federal Reserve Bank has been saying that they want to do whatever it takes to bring inflation down. However, now that we're seeing pain in the economy, they're now facing this dilemma that we've been talking about for the last 18 months, that when you raise interest rates, it's going to hurt the economy. And now, what is going to break first? Is it going to be the economy or is it going to be inflation? And the dilemma here is so important because, well, we know how to fix a hurting economy. Recessions happen. They've happened pretty much every decade for the last century. That's a part of our economic system. But inflationary issues are so much more significant because if you cannot get inflation under control, you can cause so much more pain to the economy. Inflation disproportionately hurts the working class, it disproportionately hurts the middle class, and it disproportionately hurts the poor. And so now, if you don't get inflation under control, not only do you hurt the average person in America, but you can also potentially risk a currency crisis, and that is significantly more devastating than an economic slowdown or a recession. If you enjoyed this short clip from my longer videos, here's another clip that I think you'll love. And while you're at it, if you're interested in learning more about how to start generating passive income, our team put together an amazing guide on how to start generating passive income for free. All you gotta do is click that button right over there. Thank you for watching, and as always, keep hustling.